Hello, Namaskaram. Today I am with Dhanam BSFI Submit here, and I have the fortune to meet Saurabh Mukherjee. I am his biggest fan, and and he is an author. And I have read a couple of books, and I think 5 books you have already.
Right, yes, just Nikhil. Yes.
I have a seriously great respect to people who can write. And you are a fund manager and CIO of Marcellus Investing.
Nikhil, the next book is coming out on 27th February. It's called Unfiltered.
I'm looking forward. You said that your mistakes, what you have done.
All the mistakes of my life are in Unfiltered.
Yeah, I think want to really read.
People are waiting to read that book about sort of mistakes.
No, but it will be great. And this book also, what I have seen is that you have mentioned some stories about personal finance. Then there is an advisor coming in.
Yes.
And that person's name is Nikhil.
Yes. So
and I'm that Nikhil.
Freudian coincidence. Great to meet the Nikhil in person in Cochin.
Thank you so much. So, sir, if you could, take us through your experience, LSE and your Ambit life, then you started your own venture with Marcellus. If you could briefly take us through your journey, it will be good to start.
So my parents migrated from India in 1991. So I ended up doing the finishing of my schooling in the UK. I did my class, what's called in the UK A-levels, Indian class 12 in the suburb of London. Then I went to the LSE for a bachelor's and then a postgraduate degree in economics. I became an economist shortly thereafter, worked for a gentleman called John Kay, who became my guru, remains my guru. John was in India last week teaching us about comparative advantage. And then in 2003, with a few people in London, with funding from John and a local venture capitalist, we set up a firm called Clear Capital. Clear Capital would do UK small cap investment advice. We became very well known for that. The core Marcellus team actually came together, Nikhil, in Clear Capital in 2004, 5, 6, 7. Okay. Early 2008, we decided to sell the firm. We were very fortunate. We found a buyer. 10th May 2008, after selling the firm, I migrated to India. Core Marcellus team again moved to India at that juncture. 2009, we were hired by Ambit, first to build their broking business, then their wealth management business, then their investment management business. Whilst in my closing years, in my closing months in Ambit, I ended up publishing the Coffee Can Investing book. June 2018, I left Ambit. We founded Marcellus in the closing months of 2018. And, courtesy support from people like you, courtesy support from the people who are watching. We are very fortunate today in India. We are managing the best part of 12,000 crores of Indian investors' money. Our investment philosophy, as espoused in our books, Diamonds in the Dust was the book we published 2 years ago. Investment philosophy, very simple. Look for clean companies. Promoters should have a track record of good capital allocation. And thirdly, it should be a dominant franchise which has pricing power. Invest in such companies, stay patient, stay invested for long periods of time, and compound your wealth at a good rate. Okay,
you're saying it in a very simple way. I just want to take this one. You were doing really well in Europe, UK, and in our part of the world, especially in Kerala, we all are looking to go out and build a career outside.
Right.
But what kind of made you to come back to India and start this firm in India?
I mean, look, there's a couple of things. One was at a professional level, I could see that India will have immense opportunities. So amongst other things, I studied economic history at the LSE. And one of the things I realized was when you take large free market democracies like America, like India, when you join up these democracies through railroad, broadband, telegraph, airlines, when you join up large free market democracies, you basically create giant monopolistic firms, right? The local player dies, the regional player dies. Giant monopolies are born. So if you look back at America, Ford, General Motors, Sears, Kellogg's, Wrigley's, Heinz, these giant companies all were born between 1880 to 1930 when America was getting joined up. So I felt that India will go through such a phase, and I felt that I could make a lot of money identifying these companies, buying their shares and getting rich. At a personal level, my wife and I became parents in 2007. We did some basic maths. We figured out that by 2032, India would be the world's third largest economy. And we said, why raise your kids abroad if you can raise them in the world's third largest economy? We felt our kids would never forgive us if we raise them in the Western world, in countries where GDP growth is 2 or 3%,
Okay.
and then we ask them to grow up there, because once you grow up in the West, you can't migrate to India.
yeah.
If you grow up in India, the world is your oyster.
Okay.
So we flipped it around and we migrated when
Great,
our
great.
son was 6 months old, and then our daughter was born here. So the kids have grown up here. If they want, they can carry on building their careers here. I think there's plenty to do, lots of money to be made for the next generation, incredibly bright future for the next generation. But in case our children decide to migrate, then like millions of Indians, it's very easy to migrate these days.
I think it's a great way you answered, because the point is that you had that thought process, you and your wife had that thought process to do that. I think young couple should really take that advice from you.
Take risks. When you're 20s and 30s, take the biggest risks you can, because once you get older, physically it's hard to work super hard when you're old. Plus also financially, when you have children, so our children are teenagers, financially it's a little harder. So 20s and 30s we took insane risks. I did my first startup when I was 26. We migrated to India when I was 31. My wife was 30. So we haven't regretted any of it. Take risks when you're young, because then you have a much more interesting life.
Great. And in your book you have clearly mentioned that personal finance is an important part of it, and you are a fund manager. Normally, if you talk to any fund managers, they are mostly thinking about manufacturing that particular product. But you have keenly taken interest into personal finance. Then only you are talking about your strategy and everything. So please take us through, what is that importance to do personal finance before getting into investing?
So it's very interesting. I had never thought about this, Nikhil, until you mentioned it, that most fund managers think just about manufacturing for others. They don't think about their own wealth. So as I've explained in the book that will get published on 27th February, I come from a family of very modest means, and for most of my upbringing, money was very, very tight for our family. So I grew up from the age of 16, I started working, and I grew up being very conscious that I needed to save and I needed to invest properly because of how tight money had been for the family. So just to give you a sense, my first job, I used to earn not even £1. I used to earn less than £1 an hour. So in today's money, I used to get 60 rupees an hour for 1 hour of work, and I used to work 60 hours a week to earn 3,600 rupees a week, right? So when you work for money from a very young age, and you have to work 60 hours a week, right? When you're basically, I was doing 12-hour days through the age of 16, 17.
What kind of work that was?
So I was in a bathroom fitting store. I used to clean the store, and I was also the delivery boy. So if a customer said, I want the bathtub delivered to my house, I would have to get into a van with the bathtub and deliver it to whoever had ordered this bathtub, or taps, or WCs, and so on. And if there was no deliveries to be done and the shop was clean, then whichever customer would walk in, I would have to sell to them that, buy this tap, buy that shower cap, and so on. So from a very early age, I realized earning money is tough, right? And therefore, if I'm earning money the hard way, I decided to teach myself how to save money. So from the age of 21, as soon as I graduated, I started investing. So initially, I didn't know much about stocks. I used to invest in tracker funds, ETFs, right?
Yeah.
And because I had studied economics, I had some basic idea which point of the cycle to get in, and started doing ETFs. Then I met other friends who were doing ETFs in Japan, ETFs in America, so I did a little bit of that. Then, courtesy John Kay and my CFA qualification, I learned how to analyze companies and identify good companies. So 2003, I became a proper equity analyst. Once I became an equity analyst, it became easier to identify stock-specific investing. But until I learned stock-specific investing, I used to just do low-cost ETFs, and thankfully I made my first few £1,000s by doing low-cost ETF investing.
Our passive investment.
Passive investment, absolutely.
And in Kerala, basically we all are like FD lovers, and especially now interest rate is better, and we are getting a better rate. And we invest in gold and real estate also. So according to you, what is that good thing about that, and what is the kind of improvement which you can recommend? Right.
So I grew up in Delhi in the 80s. As I said, till the age of 14, I grew up in Delhi. So my parents used to do these FDs, National Savings Certificate. They had bought a flat in the suburbs of Delhi. My mother had a little bit of jewelry, and I used to do the maths and figure out that they actually don't make any money after adjusting for inflation. So this was in the 80s itself, I figured out. My parents didn't earn much. Whatever little they were able to save, it was in real terms, after adjusting for inflation, it was zero returns. But I told myself in the 80s that my mother is a maths teacher, my dad designs oil rigs, so therefore they are not financially savvy, they're not able to make any money.
Okay.
Then I discovered that in the flat next door to us was a Malayali couple,
Okay.
the Nayars.
Okay.
I realized they're also equally clueless. So I said Malayalis and Bengalis, they must be the only clueless people in the country. But then when I came back to India in 2008, I realized most people in India are like that. So whether they're Gujaratis, Marwadis, Punjabis, Malayalis, 95% of people I meet in India, they make investment for zero returns. Right? After inflation, if you invest in gold, you buy flats, you do FDs, you do insurance policies, after adjusting for inflation, you make zero returns. And I think our country loves, most people in our country love zero returns.
We need that guaranteed return, I feel.
Yeah, so the desire for security is so intense that people invest for zero returns in our country. Now that was all right when cost of living wasn't rising very much, right? Now unfortunately, as the economy modernizes, as we start buying more imported goods, right? We're doing this interview, almost all the interview equipment is imported, right? My publisher of my books is a foreign company. The cars we drive, either the car is entirely foreign and just simply knocked together in India, or even if it's an Indian car, half the parts are foreign. Our healthcare system, almost all the medical equipment in our healthcare system is foreign. So cost of living for people in our strata of society comfortably rises at 6-7%. And if you don't compound your wealth at 9-10% pre-tax, 6-7% after tax, if you don't do that, then more likely than not, you will have a very difficult retirement.
Okay.
I don't think that point has dawned on many Indians who carry on doing this nonsense of real estate, gold, FDs, and so on and so forth. Gradually, I think as people see this happening, as they see their retired relatives suffering, they will come to their senses, and this insane desire for security will gradually be replaced by a yearning for returns. In coffee can investing, I've given the maths. I've given the maths as to why people who strive for security rather than returns will end up with no security and no wealth left. But we'll need a demonstration effect. We'll need one generation of retirees to really struggle through retirement, unfortunately, for the next generation to learn that you simply cannot afford to spend your life investing 80, 90, 95% of your wealth in real estate, gold, fixed deposits.
Okay. So when we look at it in Kerala or any part of India,
Yes.
People have a thinking that equity investment is risky. And even I was talking to one of a billionaire who has a listed company. He himself was telling that I haven't invested in equity. But if you look at it, the entire wealth he has created from the stock listed and that market capitalization. So what is that push we need to really give to people thinking about equity, and why that equity is really important? You pointed out, but what's the kind of education we need
So
to do?
I don't think push will work, right? You can't sort of push 140 crore people, right? So I think part of the challenge is perception. So if you look at the Indian stock market, over a 10-year period, last 10 years to say 2022 end, the Indian stock market has created 105 trillion rupees of wealth. Right? This is just nifty point to point. 105 trillion rupees of wealth in a 10-year period. If you look at that 105 trillion, 80% of that, say 85 trillion, has been created by 20 companies. 20 companies have created 85 trillion, right? Now, if you look at the list of 20 companies, it's very easy to say that one and perhaps two, certainly one and perhaps two of those 20 companies are crony capitalists, right? People who do naughty things. But the other 18 are almost unquestionably clean, well-managed, high-quality companies whose products people watching this video buy every day, right? Household names. So, for example, from our own portfolio, I'll give a few names. TCS is on that list, Bajaj Finance is on that list, HDFC Bank is on that list, Kotak Bank is on that list, Titan is on that list, right? So, these are household companies whose products you and I only are buying, right? They're on that list of immense wealth creation. My parents are invested in that portfolio, I am invested in the portfolio. But if you ask my parents, or if you ask indeed most people watching the video, that do you know the name of the CEO of TCS?
Yeah.
Hardly anybody will know his name. People who are watching this video, you ask them, do you know the name of the CEO of Titan? Titan has created 320x wealth in the last 20 years. Nobody will know the Titan CEO's name. Asian Paints has created 100x wealth in the last 20 years. Hardly anybody in our country knows the name of the CEO of Asian Paints. Bajaj Finance has created 60x wealth in 10 years. hardly anybody will know Bajaj Finance CEO's name. So what's happened in India is the companies that have created immense wealth using brains, sheer hard work, their names are, the promoters, the CEOs' names are unknown. Whereas the naughty people's names are known widely, right? And as a result, capitalism is seen as a bit of a gamble by many people in our country, needlessly so, given the quality of the people working, running a Titan, an Asian Paints, an HDFC Bank, a TCS, a Bajaj Finance. And that, I think that disparity has to be corrected, which is why we write books, so that people can see that the folks who are running these high quality companies are intelligent, bright, driven, high integrity people. Hence, Unusual Billionaires was our first book on this subject in 2016, Coffee Can Investing 2018, and then Diamonds in the Dust 2020. We keep writing, we keep hoping that people will read, but what people read is the wrong stuff. They read about crony capitalists whose contribution to the Indian stock market is zero.
Okay. And it's a great work which you are doing in terms of blog also, because I'm just subscribed to your blog. And
by the way, it's free. Anybody who wants to subscribe to our blog, it's free. You can come to marcellus.in, our website, leave your details on marcellus.in, and we will put you on our mailing list, and you'll get all our research, all our webinars for free.
Everything. Even your YouTube channel also great. It's a big learning.
So that's what we're trying to do. We're trying to spread the message that a Titan or an Asian Paints or an HDFC Bank or a Bajaj Finance, they're not doing anything irregular. Bright, hard-working, honest people building immense wealth, life-changing wealth. But as I told you, if you take a group of 100 wealthy Indians in any large city in India, you ask them who's the CEO of TCS, hardly anybody will know. Right? Rajesh Gopinathan's name will be unknown.
We should celebrate them actually.
So the right people are not celebrated, the wrong people are celebrated, then people say stock market risky. It's like you make yourself watch a horror movie and then you scare yourself saying all movies are horror movies.
And when we talk about the stock market, there are people comes to the market and they say that I want to invest in stock market, and they end up become traders, and they become trading and you are talking about clean companies, checking. You do a lot of forensic audit and everything, and making sure that this company is not doing any naughty things and everything. But a retail investor, they do not have the time or knowledge to do that. So what is your take for those people who are entering into trading and doing the stock picking and trading by themselves?
Yeah. So I think part of it is a question of practice. So Nikhil, if you see the data from SEBI, right, in the last 10 years, Demat accounts have risen 6 or 7-fold, which implies, Nikhil, that 80% of Indians, more than 80% actually, have had their Demat accounts for less than a decade, right? If number of Demat accounts has grown 6 or 7-fold in 10 years, that means more than 80% of Demat accounts are less than 10 years old, right? Which means that these people they're new to investing. Gradually they'll learn patience. So to use a cricketing analogy, if when we first go to play cricket at the local playground, we're not like Rahul Dravid. When we first go to play cricket, we're trying to whack every ball out of the ground, because as a child you think that's the thing to do. You believe as a child you have to whack every ball out of the ground for 6, and you believe that's the goal of the game. It takes a decade, 2 decades of training to become a Rahul Dravid or a Cheteshwar Pujara, where you realize the merits of patience, you realize the merits of building a long innings, and you realize that to become an all-time legend, you have to score lots of runs, 55 ka average, not a quick 20. Right? So that appreciation only comes with time. Similarly with investing, because our country is so new to investing, 80% of Indians haven't even spent 10 years. That means they haven't seen a proper stock market cycle. That's why they are short-termist. As they get older, wiser, richer, more mature, patience will come. It's a question of staying at it. And my reckoning is that will happen. I think as people like me, there are others like us who are writing books like us, doing webinars like us. As we end up exerting a positive influence on the public, people will gradually build patience. With experience, patience will come.
Okay, great. And when we talk about this, a new person coming to market, or forget about coming to market, but this person is not invested at all. As a fresher who got a job, recently getting salary, started managing a fund for themselves, how they should start investing?
So look, I mean, what I've said in Coffee Can Investing and what my wife and I have tried to do in our personal lives is, keep it very simple. So first ask yourself that in a typical year, what is your cost of living, right? So whatever the number is, multiply that by a factor of 3 or 4 to create a buffer for yourself, right? So if you're a youngster, perhaps you multiply that by 2 or 3. When you're my age, approaching 50, maybe you multiply that by 3 or 4. So that becomes your safe harbor. That is a rainy day fund. In my case, I put it in FDs, but others may say they want to put it in government bonds. Either approach is acceptable. I don't put it in some junk bond fund. Put it either in FDs or a government bond fund. That's your rainy day corpus. This is if something untoward happens, you will turn to this money, right? So take your annual cost of living, multiply it by a multiple of 2 to 3 of your young, 3 to 4 your my age, and that's your rainy day corpus. Set it aside. If you haven't got to that corpus, then first prioritize building that corpus. Once you build that corpus, the rest of your money should go to equities. None of this real estate and gold and FD type business. The rainy day goes into FDs or government bonds. The rest of it should go to equities. If you know how to do stock selection, then you can build your own portfolio, say read Diamonds in the Dust and build your own portfolio. But you need to work hard at stock selection. If you can't do stock selection, then choose a good fund manager. In our blogs on our website, free of charge, we explained how you can identify a good fund manager. If you can't identify a good fund manager, buy an index fund for small fee, 5 bips, right? But get into this habit as quickly as possible. Step 1, create your safe harbor, your rainy day fund. Step 2, invest in equities. If you can teach yourself how to invest in equities, do stock selection. Otherwise, hire a fund manager.
Okay. So when we talk about starting small fund and everything, so what is mutual fund and what is you do PMS?
Right.
So can you just mention the difference quickly, both the definition in 30 seconds?
Look, I mean, at one level, they're nothing other than wrappers. A mutual fund is a one type of a wrapper. A PMS is another type of wrapper. At a practical level, to invest in a PMS, an investor has to have at least 50 lakhs. That's the SEBI requirement. A mutual fund can be as small as a few thousand rupees. If you delve a little deeper, a PMS, a portfolio management services, say Nikhil wants a portfolio created only for Nikhil, in Nikhil's name, in Nikhil's Demat account. That's portfolio management. Saurabh creates or Marcellus creates for Nikhil a portfolio in Nikhil's Demat account in Nikhil's name. In a mutual fund, there is no Nikhil's portfolio, there is no Saurabh portfolio. A mutual fund is common to everybody. Everybody in the city of Cochin could invest in a common mutual fund. All of them would get units in the common fund rather than a Demat account of their own. So a mutual fund is also called a pooling vehicle. You're pooling money of thousands and millions of people in one fund construct. Whereas a portfolio management service, each portfolio is distinct, it's different, and therefore a PMS is able to do more individualized, more bespoke investing, whereas a mutual fund is a more mass market product.
Okay. You have explained it very clearly. Even then, who will be the right person who should get into PMS and who should really look at only mutual fund?
So look at the very basic level, those who can afford, only those above who can afford 50 lakhs or more can do PMS. But even then, if you have a crore of savings, should you do a PMS? I'm not so sure you should. Remember, you have to have 4 years of safe harbor, rainy day savings as well. So my suggestion tends to be to people, unless you have at least 2 crores of financial wealth, excluding real estate, excluding jewelry, unless you have 2 crores of financial wealth, my suggestion is stay away from PMS, carry on with mutual funds until you get to at least 2 crores. At the 2 crore financial wealth mark, you can consider choosing a portfolio manager. So there are 392 PMSs. I'm the vice chair of the PMS industry trade body. There are 392 PMSs, and the SEBI website gives you data on every PMS in terms of their returns over the last few years. So either hire an investment advisor and choose a PMS, or go to the SEBI website and choose a PMS.
Okay, great. And another point these days is that a lot of people are coming into trading, and they have trading means it's not our derivatives and options and futures. They are into crypto, and there are a lot of people are doing a lot of strategies with futures and options and everything. Youngsters are getting into, and they never felt what is Demat also. So what is your take on that, and what is your advice to people who are entering into trading into derivative assets?
Right. So look, I mean, everybody I meet who trades derivatives, everybody I meet, they seem to be making a lot of money. So I feel very poor when I meet people who are doing derivatives because they seem to be all making
Especially
a
on
lot of
social media, right?
money. It's only recently I read a SEBI
yeah.
research that
90%
90% of FNO traders lose money. I was astounded to hear that, right? That all these people I meet, they seem to be making money, and yet SEBI is saying 90% of FNO traders make money. So if you're one of those FNO traders,
90% don't make money.
don't make money. Sorry, 90% of FNO traders lose money. So if you're one of those 90% FNO traders, you might want to rethink whether you're investing your money wisely. It feels to me that FNO trading is closer to gambling than to investing. There's nothing wrong with gambling. You can gamble on various things. Right, I've seen people gamble on drops of rain falling on a train window. You can gamble on that as well. But jokes apart, if you want to build long-term wealth, I'm not so sure gambling is going to take you very far. Even if you're a full-time investor, you've given up your day job and all day you sit in front of a screen and gamble, you might struggle to make reasonable sums of money. If you're doing well, congratulations to you. You're on the path to maybe becoming someone who will create immense wealth. But from the SEBI data, it looks like 90% of people who are doing FNO seem to be enriching their broker and not themselves. I think in fact the Zerodha founder himself said that the vast majority of, I think he tweeted, the vast majority of Zerodha customers end up enriching Zerodha rather than themselves. And hence I come back to the point, if you can't do stock selection, you haven't got the skill set, invest in a tracker fund, an index fund.
Okay, thank you. And we have discussed points, and it's very relevant for people especially newly coming into the market and people who are thinking to come into the mutual fund or PMS and everything. So what is your final advice to Kerala audience, how to approach investing?
I mean, look, the best time to invest in equities was roughly 4 or 5 years ago, right, as India began this process of formalization. The second best time to invest in equities is right now, right? A lot of people keeps asking me right entry point kab hai, market timing kab hai. I'm never quite sure how someone is supposed to divine the right entry point and market timing. As I see it, when I look at our portfolios, profits of our investee companies across Marcellus' portfolios, across consistent compounders, the large cap product, Little Champs, the small cap product, Rising Giants, the mid cap product, Kings of Capital, the finance. Across our portfolios, profits are up YOY, profits of the companies are up 20-25%. Share prices are down 15 to 25%. So as I see it in life, when profits go up, share prices come down, I put more money. I don't run away saying, "Arey, stock has gone down." Right? Most people in India, Nikhil, have this bizarre mindset. The higher the stock goes, the more they want to invest, right? The way we have understood it, if a company halves, unless the company has been fundamentally damaged, if a company halves, you should double the position. So that's what we did on 2 of our largest holdings last year. The stock halved, we doubled the position. But as I said, the general point is, profits of good companies in India are up 20-25% YOY. They've come out of COVID looking good. As the commodity prices ebb off, profits are going up at 20-25%. Share prices are down anywhere between 15 to 25%, and therefore life doesn't give us too many opportunities like this of a jaw opening up between profit growth and share price movement. And my suggestion to everybody out there, if you are a rational person, you might want to capitalize on this.
Okay, great. And I think you have very clearly mentioned how the 5 points which you pick in terms of stock selection and everything. And there are a lot of audit also you are doing it, right? And now this is the book, Coffee Can Investing. We can go to our crossword and find this book. It's worth reading. And I got fortune to get autographed and signed from Saurav also. I think after 10 years I will give it for auction.
Thank you, sir. Thank you very much.
Thank you.
Hopefully it'll be worth more. Hopefully it'll appreciate in value.
Yes.
Right? It'll be a good contest to see, does a Cochin flat appreciate more in value or a Coffee Can Investment?
No, definitely. It's a great. I have learned a lot in this session. I think before the session itself, listening to you in your blogs and your other webinars, I got a lot of opportunity to learn many things. So I was looking forward to get this opportunity, and I should thank Dhanam for making this opportunity.
Thank you to Dhanam for making this happen. Thank you, Dhanam. Thank you to Nikhil as well.
Thank you, sir, for taking this time for for us to impart your knowledge. Thank you.
Take care.